Good morning, Ravindu. Good morning, Samindri. Ravindu, can you see the screen, Ravindu?
Yes, sir.
Right. Samindri, you also can see, right? Screen? Right. Okay. So, yeah. Thanks, Ravindu. Thanks, Samindri. So basically, until others, come on board, so we'll start briefly discussing the last week components. So today is like third day. So the day one actually we did discuss about introduction to project financing, development financing, and like categories of lending, and like brief session, right? Though that we are planning to do in detail about project financing later, but we got an idea about the brief knowledge on project financing, development financing, or categories of lending. Day two, actually, we moved to SME financing, where we discuss about SME lending, SME banking, importance of SMEs, definitions, right? Kind of. So I actually requested you to go through some of the product which I haven't discussed in detail. So you can go through the product as per the presentation or the reading materials. And later we will do some past paper questions so that you can get an idea where what's like exact application of the the product details. So today again we are moving to a bit of say part of the SME, like supporting policies for SMEs and the sources of financing. It's not only for SMEs like entrepreneurs which are into micro SME, the corporate to project financing. So that is the kind of the discussion that we are planning to have it today. So before starting today's session, so any gray areas, any clarification that you require stemming from the last 2 weeks, any sort of difficulties that you come across, any sort of ambiguities, any unclear areas? So is it anything, Ramindu, Samindri, anything that you need further clarification? No? Right. So then we'll start today's session, right? So today basically is sources of finance and the supporting policies, right? So I move to the what we are planning to discuss today is basically is about internal and external financing, and what are the exact sources for development financing, right? And then other sources also which we can get as support for entrepreneurs to start businesses, continue businesses. Finally, supporting policies and institutions. Those are the 4 areas that we are going to have a discussion today. Right. Just to not make a note of you, I think now as per the IBSL timetable, so we are supposed to complete by first week of November. So there is very high possibility that examination could be conducted if there is no other major development to the COVID or whatever. Highly likelihood that exams could be conducted in November. So make a kind of a plan of that and start your the academic or the the revisioning and going through the lecture notes and all that right now itself, right? Don't delay assuming that exams could be further postponed kind of thing. But as per the present schedule, there's a likelihood that exams will be conducted scheduled. But only thing we could expect is like if the A levels is going to be dragged like further instead of October, then there may be some kind of changes. But make sure whatever you are going to do today and to cover it within a kind of a reasonable time, so then you don't have any issues in later in catching up what the things that we are discussing then and there. So generally, sources of financing are threefold here. That's what we are going to discuss. Business growth, venture capitals, business angels. And there may be so many, but we are trying to limit our discussions to these three areas during today's presentation. Business growth, venture capital, business angels. We're starting with business growth, that is internal, external. Right? So then we will move to venture capital and business angels later in little while. So starting with internal sources. Right. Now, let's say you are running a business. You are running a business, and then if you want to move to next level, what you could do. So there are some things that you could do. First one, organic growth. So that is growth generated through the development and expansion of the business itself. How can we achieve it? There are three further sub-steps also. So first we think about, let's say, internally, how we can finance and grow your business. Major input, major contributor is organic growth. Organic growth in the sense, you are not getting any support from outside. Internally, you try to develop, further expand your business activities and get the financial resources for further growth. Can be achieved through these three: increasing sales, retained profits, sale of assets. Now we discuss one by one. Generating increasing sales. So that is very easily understood phenomena where every business can generate income by expansion of sales. That can be either increasing the pricing of the particular product or service, or increase the volume that you are targeting to your customers. Either way, you can increase your sales. Means increasing turnover, increasing gross profits, increasing operating profit, increasing net profit. Then you have cash flows. Increase cash flows, increase retained earnings. So basically, that is the most accepted and conservative method of growth. Number two, use retained profits. So by undertaking business expansions, growth, you come across, you end up with profits, right? So that profit, what you could do is you can distribute among the shareholders if you are a limited liability company, and part that you can retain for future growth. So that's why we generally call them as retained profits, and those could be used to finance the assets of the company, including both fixed assets and current assets. That again, you're doing within the organization, within the business, no external support. Third, sale of asset. Sale of assets can be a double-edged sword. Why? Why? Because it could reduce your capacity to grow. It's obvious, no? Let's say you have a factory, garment factory. Say you have 3 layouts or machine lines, example. Now, depending on the demand, you think that, rather than running 3 machine lines, good that we do a 2 machines line, and so we will dismantle or remove 1 machine line for the time being. What you could do is you can sell some of those machines, go outside and get the money, and can use for working capital per se. So what could be the advantage here? Because maintenance to additional, flow capacity to additional labor, right, additional work. So everything can be saved. You get some quick money, introduced to your working capital, so you can further move without external support. Flip side is, now, if you have 3 machine lines, your output is X percentage. Now, if you remove 1, obviously that can be reduced by some percentage. Means output is now limited. But remember, your competitors are out there and they cater that market also, like you. So your contribution is now coming down where somebody else's would get that market. Right? So means it's a double edge, right? So you lose your capacity, reduce your capacity, yes, you are getting something. So whenever you are going to do that type of activity, you need to be very much careful, right, to do or not. But it's an option. It's an internal source that you can use to increase your financial capacity, financing position of the firm. So organic growth is, very much easily available option, strategy to finance the business. Can be achieved through increasing sales, using retained profits, or selling some of the assets. Fine. Then we move to external sources. There are enough and many external sources also. What are the external? External means it is not coming within the business. It is coming outside to the business. So that's why a bank's role is important in external sources. Example, long term, where you go to a bank, finance company, and get the financing and introduce that into the business, right? Maybe paid back after many years or not at all sometimes, because it could be a grant sometimes, right? It could be a grant, it could be aid, it could be long-term funding, depending how you negotiate, but it's coming externally. That mainly used to finance to your capex in the business, land, building, machinery, vehicle, like that. Similarly, there are short-term financing methods also. Short-term financing methods also there. That is for your working capital financing. Suppose that you have to finance your stocks, debtor, overhead expenses. So that can be fulfilled, accomplished by short-term financing. It's like overdraft, import loan, pledge loan, hypothecation loan, packing credit loan. So many options. So we have long-term and short-term financing options where a business can get the funding outside. Third one is important one. Inorganic growth. Inorganic. What is inorganic growth? Growth generated by acquisition. Means, let's say you are a company who is having some financial capacity and running very well, but you need to grow for next level. So that what you could do is you can do organic growth, as we have discussed previously. Similarly, you can do inorganic growth also, like say you are just now purchasing something and selling, or do some value addition at your premises, and then even the selling is done through outsourcing. So no input, no output at sales. Only you do processing value addition. Suppose if you want to acquire a company who is into the manufacturing of raw material or the input to your company, you go to supply side, integration. Similarly, you go to buyer, distributor, integration. You purchase distribution company, you purchase supplier, manufacturing company. Now you are in a fully fledged supply chain provider. You are fully equipped with A to Z in operations. Means you acquire some businesses, right? So by way that you can go to next level, like banks, for example. Say you are a development bank, but if you want to move to retail bank, what you could do? You can get the license and you can start it from the scratch, and you can, go for retailing, and then you can become a retail bank. Vice versa, what you could do is you can acquire a retail bank with the permission of central bank guidelines, directions. It's a merger, for example, or acquisition of another bank, small bank, with retail bank license. Now day two, now you have become a retail bank, right? Or you have two bigger banks, bank A, bank B. Rather than acquiring, you try to get a merger between A and B. Now it's becoming maybe top three. Now we are moving to top three now because of this merger. You become a big bank. It's a merger through acquisition or merger. It's inorganic, not is organic. It's coming inside. Hope you understand. So here we are discussing internal sources and external sources. Okay. Any questions? You can, refer me and we discuss. Here we'll share some thoughts, but not going to very much detail, but you can read through. But we'll discuss some long-term options where entrepreneur, a business, can access to finance. Ordinary shares, preference shares, new shares, right shares, bonus shares. There are several options. Let's say we'll discuss one or two here. Let's say you are a first time you want to go to, or you are going to get some shareholders outside financing. You can issue new shares, ordinary shares with voting rights. Dividends can be paid. And then you get some people on board by investing on those shares. You issue shares on behalf of the cash you're getting. But remember, they get some ownership now. They get some control. Earlier you have 100% control. Now you decide 25% of your total control be vested with outsiders through ordinary shares. So they have voting rights, they have control, they are coming to your board, but still you have the majority ownership. But remember, when you go to the market, you need to ensure that the majority control should be retained with you. Otherwise, through market, even the competitor can come and acquire the ownership of your company, right? So that's a bad side of going external, whatever method, because the third parties can control, right? Even for a term loan, what happened? Because a bank would come and demand you kind of terms, different conditions, some kind of a what do you call observation. So many things could happen, right? It's not only now your business, so they can intervene you to some extent, depending on what's the instrument that you are going to accept or explore. Preference shares, it's maybe after ordinary shares as another set of shares that you can issue. That's we call preference shares, right? So they be in a what do you call priority order. They are placed above the ordinary shareholders. It's like that. Maybe new shares. You can, if you want further financing, you can issue further new shares. Or maybe right issues for the existing shareholders, you can issue some rights or bonus. Like if you have some shares, you say every 4 number of shares, I'll give a 1 bonus or script issue. Again, you increase and get some money, cash into the business. So suppose the examiner wanted us to write a short note on shares. So you need to put some explanation and wording to that, and you need to understand what exactly that instrument. It's a long-term financing option, external financing option. What are the main features? What are the advantages? What are the risks? So like that, as I discussed the other day, you need to know that what to write, like 3-4 lines for each item. It could be product, it could be something about sources of financing we discussed. Any questions here before moving to the next one? Any questions? Anything not clear? All well? Fine. So I know it's not very difficult, but make sure that these things been, gone through very well, because sometimes there may be examiner would ask about some short notes on product. So there are some other areas where debenture, bank loans and mortgages, merchant or investment banks, government or European Union. So again, they would provide a long-term financing to us. I think we have a question. If it is a right issue, is there any cash injection to the company? Ravindu, it's like this. Now, sorry. Right. In a rights issue, what could actually happen is, now, if you already have, if you are an existing shareholder, then the bank would tell you, so we will issue additional 1 share for each 3 and it is a rights issue. So it's first offered to you, and you can purchase that, paying some money. Company get cash. Let's say if you are not interested, then the company can issue that shares to outsiders. In a rights issue, basically, what we are trying to do is we are trying not to dilute the ownership of main company and excess shareholders and increase the cash into the company. That's what the rights issue is, a concept. In case of bonus issue, you are not supposed to pay. It's a bonus, as word tells. But rights means you have to pay, but it's a first right the existing shareholder is having. Right? If you are not purchasing, only the company can go to outsiders. Hope it's clear, Avindu. Is it right? When come to the loans, they are not like shares. Right? Shares is something ownership. Loans, it's like creditors. Right? So it could be debenture, it's a type of a loan. Bank loan, mortgage loan, you are dealing with the bank. Merchant investment bank, so they again underwrite some raising finance. Let's say if you want to go for a share option, sometimes the underwriting company could be a merchant or investment bank. So they come and guarantee, underwrite the particular share. Right? When you say they are going to guarantee, then more acceptance in the market, underwriters, right? Rather than you just go in and float a share, these companies, they come and do support and they underwrite. Then government or European Union, maybe they also offer long-term financing to, example, say central bank, and then they through IFC, there may be non-financial organizations get money, or even some businesses. Also, you can get depending on how established you are and what your propositions are. So means it's again interest-free or concessionary interest loan, or it could be a something coming for a longer tenure. But main difference between shares and the loans is loans are outsiders and they are not owners, they are creditors. But when you say shareholders, shareholdings, shares mean they become owners, they become controlling parts, entities in an organization. Short term is something, another outside mechanism where you try to go to a market where financial, non-financial players are there, and then you try to get short-term financing to support your business. Like it could be bank loan, maybe up to 1 year repayment. I mean, last week I requested you to go through some products. So most of the products are like this, maybe short-term and long-term financing propositions. Overdraft facility, trade credit, factoring, leasing. There are so many short-term financing methods available. But leasing are not exactly short-term, but it could be something short to medium-term also. But rest is like if it is coming within a year period, mainly to finance working capital requirement of a business, right? So you can treat it as a short-term financing propositions. advantage here is in a short term, because you need not to sell maybe some of your assets, as we discussed in the internal, right? There's no controlling interest from these banks or the providers on this financing, right? You can borrow it, invest in the working capital, you can sell it, get the money, and you can roll it out, like you can continue doing your businesses. That's about short term, right? Any questions on this? These are not exactly very difficult, but only your concern should be, in case if the examiner wanted us to write a short note, describe something, right? So these things are very important in the context of development financing, right? Because it is irrespective that you are doing entrepreneur, doing general trading, general business to development financing, but these are commonly available. It is common for a client who is starting a hotel or a client who is running a day-to-day business. So both occasions, these products are useful, whether it's coming externally or internally, depends some, gives some idea where we are losing control of the business or we are retaining the control of the business. In internal, no worries, everything's under control. When you go to external, there is a chance the outsiders come and play a bigger role. If it's a shares, yes, ownership could be transferred to third parties. But the term loan to short-term loans and all that, so ownership is not going to, but still maybe third parties can intervene your day-to-day businesses. Obviously, bank would come and asking different information about financial requirements, conditions, stock inspection. So many other things could be coming as a part of the loan package. Okay. Any questions? Right. Inorganic growth. So, though that we have discussed in briefly there, inorganic growth is another method of external financing. As I said, it could be a merger, it could be a takeover, where it's a big company can take over a small company who is into manufacturing, who is into distribution. By doing so, you are getting income. Sorry, you are getting a control, right? You are getting a control there. Similarly, if it is a merger, it's level playing field where there may equal rights for both bank A versus bank B. You're not going to be play a second role there, secondary role there. Both are primary kind, both are concurrent. So we are in the same wicket. So I lose something, but I get something. The other guy also lose something and he also gets something. So like that. So both in a same level depending on the bargaining power. But if it's an acquisition, sometimes you lose everything to a bigger company. It's obvious, no? Because I purchase another company, then so everybody, including the mission to business strategies, now should be in line with the bigger company. But in both scenarios, what happened is it paves the way for growth. Earlier, bank A, bank B, separately out of the 10 point, it's 5th and 7th. When 5th and 7th got merged and become one bank, now it can be third in the 10th point ranking. And similarly, through acquisition also, because earlier you don't have the advantage of being a rope manufacturer, or earlier you didn't have the advantage of being a distributor. Now you have the distribution, manufacturing, processing also. Value addition here. So A to Z, everything is now with you. Any question? Tanya, Roshni, Ravindu, Ravin, Ihani.
Yes, sir.
Okay. Chandran, any difficulties? Anything to be additionally cleared? Okay. Please let me know. Yeah, very good. Subsidiary. Yeah. Samindri, the subsidiary companies is like, let's say you are a bigger company, and let's say if you want to move to example some other country, say Maldives for example, there what you can do, sometimes you can have another company, and with you can make a joint venture. Two companies get together and do the businesses. Again, bank A company, B company jointly doing a business there. So when you say the joint venture, again, both has equal rights, right? Have the decisions are being taken collectively. That's like you if you want to move to another territory, that's how you do. That's what the joint venture. It's a subsidiary means you will have another company, but at least you have a 25% ownership of the particular. And when you have say 25% ownership of the company, so then it becomes your subsidiary, right? So basically it's not a joint venture, but so they operate on behalf of you there. So minimum 25% or more, then become a subsidiary. Why we are doing that is sometimes, let's say if you want to be in business in the Maldives, so you go and have a, acquire a company, but your share is now more than 25%. So, and then it can go up to 50, 60 and more than that. Means you have a control basically. It's beyond 25% and you have a control there. And then basically whatever you want to do as a company, the particular company being your subsidiary will work for you. The costing from the subsidiary to a main company could be transfer price sometimes. It means it's another company under you. It's a subsidiary. Another concept is associate companies where you don't have a controlling interest. If you have say 20% ownership or so, it's an associate. But you get dividends, but you don't have a controlling interest. But in a subsidiary, you have a controlling interest. Minimum should be 25% or more, but you have a controlling interest. Associate is minimum is 20%, but there you don't have a controlling interest. But again, you get some dividends from the earnings. So we have associate companies, we have subsidiary companies, we also have joint ventures also. So joint ventures, you don't have much control. Subsidiary, you have 100% control because you are minimum share, minimum control should be 25% or more, and you have that control. Right? Why I must say the 25% is like if you have 25%, the rest of all have not having the 25%. Collectively they can have, but a controlling share is with you. Ideally, it could be 100% because it's your company. It's another ABC Private Limited. So they could be AB Extra Limited, AB whatever. So basically, director board and everything is being appointed by you. You have that control, subsidiary. But associate, 20% share, but you don't have the controlling interest. But they act as a like-minded parties, or they might give you a bonus, right, for the dividend, because as per their earning. So basically, it's another method of managing your businesses, especially maybe outside territories, right? Because you can't go and do the business there, but you form a small company based on the rule of the particular country, but you have the controlling interest. But income and everything could be coming to you because it's owned by you in a mechanism called subsidiary. Hope it's clear, Samindri. Okay. Now we go to the next one, business angels. We have business growth. We talk about internal, external. We go into details. So I request you to go through each products or the sources, instruments, in a way that in examination that we could be tested, and then we move to the business angels and the venture capital. Again, there are some other sources of financing for the entrepreneurs, may not exactly for Sri Lankans, but in general, these are the another sources available. So business angels, these are individuals looking for investment opportunities. We generally small sums up to 100,000 pounds. That because why I put this in pounds, because we don't find many angels in Sri Lanka, but in UK and in many developed countries, you can find the business angels operating in this way. So could be an individual or small group, generally have some say in the running of the company. So here what happened, let's say you are an individual or a couple of individuals, you have some funds accumulated under you, and you are looking for some business opportunities. In Sri Lankan context also, you can see, there are some advertisements saying that, is there any, there is an investment opportunity, come and invest kind of thing. Similarly, like those, but here we call business angels here, smaller investments, not bigger, right? These individual, these investment opportunities are smaller, right? Maximum up to 100,000. But once you invested, once you enter into the businesses in different nature, you have some control in running the company. Maybe you can be appointed as a director, right? So you can be a controlling or rather you have some say, not me always the controlling interest, but to the extent of the investment that you will have that controlling power. Then venture capital is a different one. It's the biggest, not the smaller. Even Sri Lanka, we have some venture capital companies where you are trying to support the particular company, right? And which the banks or the traditional financial companies are not willing to enter into, because the proposition could be high risk, right? Maybe risky. It's not, it's above normal risk sometimes. Amounts larger. You have the expertise, right? As a venture capital company, you have some expertise in running hotels to IT companies to manufacturing, because you have some experts. That's why you are trying to enter. It's long term, not a short time, maybe 3, 4, 5 years, because you try to support the business from the inception. And after some time, after the growth, so what you could do is you will make the business flourish, and then you even can sell to the owners and you can leave out after getting the investment. And high growth, not very traditional business, but high growth, maybe IT or maybe some other business process engineering, like some BPOs, because it's like high growth industries, high return, high risk. So that's why they are coming. Otherwise, you can go to a bank, or maybe merchant bank, investment bank, maybe a development bank, right? You can get that. But banks are not willing to take that risk. because it's high risk. At venture capital, yes, they will come and support you. Right? These are some of the features. Pooling of capital in the form of limited companies. Right? Looking for investment opportunities, fast-growing businesses. May also buy out firms in administration. Advice, contacts, and experience. So they are into both. Right? They are into both. They do financial support. They do non-financial support. Even they buy out, they enter. The businesses are not happening well, performing well. It's a high risky, but high return. They come up with expertise. They come up with bigger amount and the controlling interest also, not like 5%, 10%, 15%. They maybe invest 70%, 80%, and they take the ownership. They run the company for you. So after some time, so businesses can come to a level where self-sustain, and then they sell it to you and they move out because they try to get back what they invested. They can do because this high risk, high return, high growth, high rated industries, but very risky proposition. That's why we call a venture capitalists. Business angels in a bigger way. Banks, non-financial organizations, traditional organizations are not willing to take that risk. Okay. Any questions? This is very important because many a time examiner has tested us on these areas. Any questions? Announcement, I think 23rd OAD, right? So they have scheduled a class. So similarly, like we start 8 to 10, we will have development financing class, because why they have arrange a special class in the sense, as I was telling you earlier, they are planning to complete the scheduled class by October end or first week of November, and they plan to have exams on mid-November. So like last time, we don't have leeway, so they maybe maximum, if we are doing some extra classes, maximum we can do some 20 days as against 23 in general. So even sometimes we made like 25 classes last session, so we did have a lot of extra time for past paper discussions, but since that they are stick to like 21 days this time, including these holidays, so we need to manage the sessions very effectively. Hence that we are supposed to have extra class on 23rd, right? So we are planning to discuss some microfinancing propositions or microfinancing related areas on the 23rd. So it's a kind of an announcement for you. Probably you will be getting the link also, but I am telling you beforehand, right? Any questions on this? Right. Then, so basically that is it about sources, right? About 3 areas: internal, external, or basically business growth. That's number 1. And then business angels and venture capitals. We have done that. Now we are trying to understand something which is very important for companies, businesses, individuals, people who are into development financing. They may be doing development activities, maybe development projects. So like several, maybe tax measures, international institutions, foreign direct investment, debt forgiveness, aid, special drawing rights, international financing facility. There are so many things, even if you think about in Sri Lanka today. So we may also, as a country, need some financial support. It could be through International Monetary Fund. It could be through the countries that already supported us in terms of financing, and we might needing a pre-structure kind of a support, right? Or maybe debt postponement, right? Or even it's good that debt forgiveness kind of write-off of some debts, better, right? So like that, it could be a country, it could be a nation, it could be businesses, right? So we can name it, and then we have to see what is the available sources for your development activities. That's what we are going to discuss here now. You can ask any questions while we are, discussing these, right? International institutions are very much important, or they are playing a very important role here. That's one of the sources. Now let's see what are these international institutions. First one is World Bank. World Bank is an agency of United Nations. A group of 5 organizations, we'll see what are those shortly, providing funds for projects aimed at alleviating poverty, inequality, and promoting development. 184 members. So sometimes you have seen or you have heard World Bank is assisting you for developing countries or poor countries, because they provide financing for different objectives like poverty alleviation, to manage or inequality, to promote development, to support women empowerment. I mean, there are so many objectives of the World Bank financing funding, but they are not providing funds to support balance of payment issue, or maybe to support reserves in a country. No, they are not doing that. World Bank, yes, they do financing. They do financing support for different objectives. They have different agenda. But you need to know, as an organization, World Bank, yes, they do provide financing, and they undertake different aspects of financing. Then there are 5 other institutions, right? So we, because very rarely, recently, we have seen that, these institutions has been tested. But good to know, under the World Bank, there are 5 components, 5 organizations: IBRD, IDA, IFC, MIGA, ICSID. We go one by one. International Bank for Reconstruction and Development, IBRD. What they do? Loans and advices to poor countries to assist development, right? So IBRD is a bank coming under World Bank, so they provide financing, and also they do financial advisory services as well. So loans, advisors, both. To whom? Poor countries for development. So they are purpose for development purposes, and then they provide loans and advices. Fine. Then IDA, interest-free credits and grants to countries who are not able to borrow through normal market channels because, let's say, due to poor ratings, so due to some other, the standing of the country, they may not go to the market and borrow it, as some other countries can do. So as a support, IDA, they provide loans, but they are interest free. Not every time, maybe selectively they would finance, they would undertake financing. Third one, IFC. They provide finance through private sector for development. So if you remember, now in Sri Lanka also we have IFC office and they undertake financing. So they work with many banks, institutions. Maybe SDB recently, NTB, LOLC, right? Or maybe NDB. So they are working with many private sector organizations and they provide financing for development purposes. MIGA, investors with protection against risk to promote investment in development countries. So that is, now it's like for investor support. Let's say if the investor wanted to go a country maybe very poor with lack of regulations, lack of financial discipline, but so they act as a guarantee, right? They give the protection for those investors, right? Then International Center for Settlement of Investment Disputes, arbitration services. Maybe that you invest, there may be some, the issues with the particular country rules and regulation. So then World Bank involved and they do this type of services. So here, basically there are 5 organizations. Some do financing, some do advisory services, right? This is actually just for your knowledge because I haven't seen these things has been tested extensively. But good to know what the IFC is doing. Out of this 5, IFC is important. So make a note of that. IFC, what is the role of the IFC? Right. When I go to the next slides, I'll further explain where this is IMF. Now remember, when you have been asked to write short answers on, write 2 names of multilateral organizations or multilateral donors who provide financing for development activities in a country, many students can write so many things, no? World Bank, ADB, IFC, right? All you can write. There are so many things. German banks, Japanese bank, so I will show you what are those names in time to come. But make sure IMF is not a entity which provide financing support for development. Keep that in mind because that's exception. Even today that you have been hearing IMF involvement, some people are talking about why not you go to IMF and get some funds. But remember, they provide funds, but not for development activities. They provide funds for what? That is basically they provide funds for stabilize the balance of payment issues, reserve issues in Sri Lanka. So many are talking about our reserves are now dwindling, coming down. Now they provide financing to make them stable. So they will give. So you have to keep it in a separate account, to have that a fund. You can't use it for consumption. You can't use it for development. That could be import-export balancing. Yes, you can use it as a cushion. Let's say some funds that when you have some funds, what happens is it's like a comfort to you. Because then, let's say now it's 3 billion, for example. you get 1 billion from US dollars from IMF, then it's go to 4 billion. But in a country that you need to have a minimum reserves, because otherwise the rating and everything could be impacted. So even outsiders, we can say we have 4 billion. So because that 1 billion, you can't use it for any purpose, but for only reserve maintenance. So that's why IMF is coming and helping you, especially when you are in a difficulty due to pandemic. Yes, they came up and they say, so we are there for your support. You need to repay it later, but means that that cannot be used for development activities, right? So that's what it basically say. It supports to stabilize the international system, monetary flow, trade cost problems, and it provide advices, balance of payment issues, both advices and financial support. The financial support is basically funds can be granted, accommodated to support the balance of payment issue, maintain the reserves, not for any other purposes. But World Bank and IFC within the organization and some other like organizations like this, here, this IMF, like this, are there for you to get money, right? So when they ask about what are the organizations, where world organizations, where a country can get the money for development, these are 6 of the organizations. You can write 2 or 3. But recent past, we have not seen any questions to that extent, but there were some questions previously. What are the organizations? Asian Development Bank, Japanese Investment Bank, International JBIC, International Corporation, JICA. Recently, you have heard that JICA has come up and give some financial support to bigger ventures in Sri Lanka. German Development Bank, which is KfW, and International Financial Corporation, that is IFC, International Fund for Agricultural Development, IFAD, right? There are so many organizations, world organizations, where you can get the financing. Fine. Any questions? Before moving to the FDI, any questions? Right. So when it comes to the foreign direct investments, FDIs is another method of sources, right? The first one is basically there are organizations, foreign banks, including World Bank, they can do financial support to organizations, banks, or entities which is in development, which needs development, or which is like what we call developing countries, located in developing countries. That's one. Number 2 is the FDIs. That's another method of where we can get the financing support. So let's see what the features of FDIs. It's like this. Very important area again, but now we need to make sure to get the FDIs in a way that we don't have an impact, right, by way of getting the FDIs. So we'll first understand what are the FDIs. So when you talk about foreign direct investments, first thing is we need to have a better environment, adequate rules, regulations, adequate policies to attract investments. But otherwise, that they may not come and operate as expected, or they They may go to some other countries which they have easy what do you call rules and regulations they can manage. Generally, FDI is coming to multinational companies because now they, there should be some kind of stability to start a project, and then it could be a government to government, or it could be sometimes a bigger company involved with a foreign entity, and together they work. What are the policies that they expect? What are the areas that one has to be mindful, like infrastructure, security, peace, local laws and regulations? Right? There are so many things. Because these are very important. Why? Because now, example, if you say infrastructure, now, if you want to come and if you want to invest, then you need to have a proper infrastructure. Why? Maybe harbor to transport to airport and all that important, because yes, they they come and they invest, and there may be a chances to get the, let's say, raw material quickly, finished goods to be exported without any problem. Or maybe we talk about electricity, water, kind of a utility would be very important, right? So if you don't have those things, then there may be a less appetite from the investor's perspective. Similarly, country political stability, peace. If you remember, when we were having dark period at the time of war, not a single investor come and invest in Sri Lanka. But just after war, it was seen that so many investors come and start building to so many things. That's a FDIs. So if you go to the last line, as-paid credit has been means by which MNCs can exploit poor countries. So that's the the thing that you need to keep in mind, because based on the name, they can come and do invest. FDIs. But they can exploit the labor, other facilities, right? So you need to be very careful when setting the rules and regulations, and also there may be some kind of a controls to manage the Sri Lankan or the country's identity. Otherwise, maybe they may not pay enough salary, or they may get whatever maximum from the raw material in Sri Lanka, and they do value addition and get everything for them. So many things could happen. So that's what we are getting some complaints now. The Chinese invasion, so they come, and even now they undertake project as a foreign direct investment and kind of a joint collaboration. And instead of using the local labor, they use Chinese labor. So many things. So need to be very careful when you are dealing with those FDIs. It's a like double-edged sword kind of thing. You need that to grow. Similarly, once they come into play, there is a highly likelihood that they exploit the local resources. So you need at least with control. You need it with control. So Senesh is asking, venture capital businesses, Senesh, right now, not many in Sri Lankan context, but there is one company under LOLC, I suppose, and some banks some merchant banks also conducting venture capital businesses. If you go to the web, there are one or two venture capital companies operating in Sri Lanka, but there are very limited venture capital by name registered as venture capital. But the venture capital proposition is being practiced by some merchant banks and one of the subsidiary of LOLC. Because now Sri Lanka is very much popular like angel financing, but there are some, right? Some are like not registered level they do, but only one or two companies registered and do the businesses, right? Because there may be, the people, whoever who are into this venture capital, they, they should be, bit of innovative, entrepreneurial, and they should have the high risk appetite kind of thing. But very rare those companies and individuals as of now. But one or two companies, one basically the registered company, I think under the LOLC, the rest are operating without like a registered companies, right? That's about the venture capital examples in Sri Lanka. Then 8. So this is again very important. 8. So this is it could be bilateral, it could be multilateral. Now 8 also very useful, and you need to be very much careful when getting 8 also. Why? It has some stringence also coming with those 8O donation. Now, example, set aside this. Now, recently we see some companies, some countries sending us some aid by way of, say, free vaccines, donations. It is good that if they are coming in a good motive. If there is any underlying different motives, then we need to be careful. Similarly, aid in terms of development. It could come, and again, if they're expecting something more by offering aids, then it's not good. It could be country to country, it could be many country to single country, like maybe China, Japan. We seen that so many things has been given under as aid. But if it is coming with different motives, then we need to be careful. Otherwise, it's a good thing, especially a developing country, because sometimes you may not have that capacity in terms of knowledge, expertise, skills, financial resources. It's good that if somebody can, come up and give that support. Okay. These are the benefits and cost. We'll discuss that as well. It helps to kickstart economic development, obvious. It is used to help develop vital infrastructure needed to encourage other investments. That's again very important point. Let's say they can come up with a bigger investment as aid to support the rest of the economic activities, investment activities. It could be related to power, it could be related to highways, could be related to harbor. There are so many, right? Because if you are going to do that alone, maybe as a government, as a country, you don't have adequate financial or other resources. But if it is coming free from another government, it could be very useful because it could help to other areas to develop. Right? Those are benefits. Then costs. Not always used for appropriate purposes. Can be linked to various strings that may not be in the recipient country's interest. That's what I was telling. crowding out of domestic investment, creates a dependency culture, distorts the working of the market. So these are some of the negatives. We can take a couple of things like not always used for appropriate purposes. Yes, intended purpose is for this, but when you get that, you use it for different purposes. Then there is a no proper utilization or output. Can be linked to various strings that may not be in the recipient country's interest, because there may be follow-up objectives, which is not the intended objective. They want to give something and we need to get something done for them, which is not good for our country. Then dependency culture. So we get something, so we also next time also we feel yes, it's good that if we get something from outside, like we got the Janasabhiya to Samurdhi to and all that, right? And then so people have dependence because the government gives us no, like that. So we as a country also we see the China can give, Japan can give, US can give, so dependent. So less entrepreneurial skills. Distort the working of the market, because now when you get something free, then whoever who is trying to do it all at a cost may be impacted, right? Because if you get something free, then people wait and so people buy that rather than paying something to you. So the workings of the market could be impacted, but there are some benefits also. So you need to make sure that the always more benefits and manage benefits while minimizing the cost. It's a good thing that you can work on, because as a developing country, you might not be able to do everything through your own resources, your own money. Okay. Any questions? Any questions up to now? Nothing? All clear? Right. Then we move to the credit guarantees. So I will explain one or two examples and you also can see this. So this is another support. Maybe now we discuss about some sources and we discuss about some institutions. Now we move to a support towards entrepreneurs in terms of development financing. So credit guarantees are a very important tool. I'll explain what is that. Suppose you are a bank who undertakes financing to micro entrepreneurs, or maybe SMEs, or maybe plan to into project financing. Suppose some of those clients in a sectors where you feel risky, say agri for example, farming, paddy, there are highly likelihood that those sectors or those players could go to bankrupt or could not do well as to expectations. Hence, you might not willing to advance. no go ahead with the financing. In case of a default, in case of a NPL, we will guarantee a part of the cost being borne by us. That's a kind of a guarantee they would give. So if it is so, what happened? Then I am in a position to support these needy sectors, though it is risky, because there is a backup option. Some examples. Let's say some time back, so we had some pawning, gold crisis, and then we were unable to advance more than 50-60%. Then the central bank came up and then they said, so we will guarantee beyond 55 to 60%. If you fund up to 70%, in case of a default, we will come up and support you that 10 to 15%. Then what we could do as a bank, instead of giving 60%, we go to 70%. With that 10% will be looked after by central bank through a credit guarantee. Or maybe import credit guarantee like SLASIC, where you are into exporting. You produce something and you export. Pre-shipment, post-shipment. Then the SLASIC will come and give a guarantee to a bank on behalf of the particular individual. In case if you're not going to do well in the pre-shipment, we will guarantee that cost or the advance. Post-shipment, you ship and the buyer may not be sending the funds, but we will give a post-shipment guarantee, subject to some conditions. But it's a cushion. It's a comfort to you. Credit guarantee. It's a support. It's a support area for entrepreneurs, development financing entrepreneurs. Instead, you don't have a guarantee backing. When you have a guarantee, you are in a good position to go to a bank and get the money, because the bank is encouraged to finance more because there is a back instrument. Okay. Any questions here? Any questions? Okay, clear? Okay. Right. Now this one is another option. Yeah. Interest subsidy. This is also sometimes we can see in Sri Lankan market where interest subsidy, not exactly for the entrepreneurs, but some other players in the market. Now, classic example is, let's say you are a person who is working to say some entity in Sri Lanka. So you take some loans from a bank. So for that you have to pay capital and interest. But for your interest payments could be borne by your organization. It's a support, interest subsidy. Right? Or maybe you earn profits, you have to pay taxes, but there may be, you are paying interest to the bank, so that can be tax deductible. The percentages could be varied. That means, again, you are getting the benefit for tax payments, against tax payments. Right? So there are those opportunities. Again, it's a comfort for you because you talk about your cash flows. The cash flows is being now less impact because of these interest subsidies. Advantage being the entrepreneur, different. So if you are maybe, yes, you are working person, but you get some benefit. I just want to share the concepts here, interest subsidy. And if you are into a let's say, paying taxes, and then you get some benefit through this tax deductions. But the concept is important: interest subsidy, interest rebate, or rather, sometimes that you have seen a recent past, what could happen is sometimes the government come and waive off some interest on some sectors, write off some interest. Yeah, it's a cost to the bank, but in terms being compensated through treasury bill, treasury guarantees, or treasury bonds kind of thing. But it's advantage to the farmer sometimes because they are debt ridden or they were impacted due to sector issues, through floods, through some other natural calamities. So interest subsidy, right? Even the moratorium recent past that we are talking about, but it's a support, right? It's a support to these clients, support to these entrepreneurs by deferment of interest. And later you'll be given chance to repay. It's moratorium, some advantage. Okay. Refinancing. This is very important because time to time we have been tested on these areas, right? Now, as the concept, what is refinancing? It's like this. Take some time and explain this. Now, let's say we have a central bank, right? And then we have some other development or commercial or banks, and we have customers. So generally, if the particular bank wanted to give facility to the particular customer, so based on whatever understanding and everything finalized, and then you give a loan to a customer, let's say at a market rate 10%. Right. Now the client has to pay the capital and interest at a rate of 10%, computed interest and the capital as pre-agreed. Now suppose the central bank can come up and advise you, say that if you finance, if you use the funds allocated for this particular objective, this particular project, this particular sector, through a separate funding component. Let's say solar power, for example. Now, if you just give your money to put a solar power unit installed in your home, say 10%, because it's a bank funds. But now we can see there is another credit line component, financing amount, which could be useful for solar power projects at a cost of 4%. So then if the bank can use that funds, then instead of giving 10%, we can give that money at 4%. Means bank would give at 10%. On receipt of that 4% money from the central bank, we can reduce the 10% to now 4%. Why? Our cost also now come down because we use that a special fund. That is called the refinancing. Means there are some concessionary credit lines towards some sectors and individuals which need financial support, which they are into development activities in a country, right? And we are in a position to offer that benefit to the clients. It could be Saubhagya, Susahana, solar power, maybe tea development, and so many credit lines available in the market. Right? The advantage here is instead of market rate, we can provide financing at a lower cost. It is benefited both bank and the end user entrepreneur. Why bank? Because we get that funds maybe at 2%. And we lend at 4%. Our margin is 2, but our cost of funds is 2 as against lending at 4, 2% margin for us. But if you go for 10 years, you have 4% margin, but higher risk. At 10%, there may be higher default. but 4% lesser default. In this case, it's not your money, it's somebody else's money. Because in earlier at 6%, you need to go to the market and source it. But here at 2%, you're getting the funds from the government or maybe through some foreign funding. That's the advantage of refinancing. Another thing is, through refinance, you can attract many customers, entrepreneurs. Why? At lower cost, they will come and bank with you. And then you can add so many value out to that. Maybe the cross-selling to and different things. And do better financing. Fine? That's the concept of refinance. So there may be a chance that examiner would test us on current refinancing credit lines available in the market. It is changing time to time. So what you could do is, so you can go to maybe People's Bank or Commercial Bank, one private bank and one government bank website, and just see what is the refinancing credit lines available right now. So you can find so many. I have also mentioned few here, but I haven't give details here. Then you say T development project fund, and they might say what is the maximum loan amount, what's the features, grace period, the tenor, interest rate, purpose, areas that you can use. Like 3-4 points would do. So see what is the available credit lines in the market right now. The Saubhagyas right now it's there. Some ADB funded credit line. You also can get the idea from your bank also, but very universal, common in many banks. At least we need to know 5 to 10 credit lines available in the market right now. Because there may be some questions like what is the interest rates in T development loan scheme? What is the interest rates, prevailing interest rates in Saubhagya credit line? So he might ask those things. But everything is in the the particular webs, but good to know and get familiarized. If it comes that 2 marks question. Okay. So that's about refinancing. Any questions from you? Anything to add on? Anything to be clarified further? Yes, Anish. Saubhagya credit line, actually it's not only limited to the moratorium. The Saubhagya it's a refinancing credit line. A moratorium benefit is another concession that we can discuss under this, because as like refinance, interest subsidy, credit guarantee, right? And the moratorium benefit also, it's a support that we extended to the entrepreneurs who are in a difficulty. Saubhagya credit line is obviously under one of the refinancing credit lines, which is very much popular these days. Yes, so he could test on what Saubhagya, what the interest rates, what are the areas that you are financing, sort of questions that he can pose us. Any other questions? Praveen, Ravindu, Samindri, Gihani, any questions?
Clear, sir.
Right. Any other? Yeah, Chandran, Gihani, anything? Right. Okay, now we move to the next area. These are some of the things also that which is useful for us. Supporting policies and services other than that what we have discussed. So we discussed basically what like sources, institutions, and supporting tools. Now supporting policies and services in the last one we are going to discuss. So this is again very important. That's why I always encourage you to go through, say, some papers, daily papers, budget speech, monetary review, right? Because very much current. I mean, you can't put everything into a lecture and discuss because things are keep on changing. So you need to understand, right? So recently they have also come up with some budget and tax concessions on SME customers, on some sectors, on changes in the pay as you earn, pay. So very important those. So you need to be familiar. What are the concessions granted toward SME sector? What are the concessions towards microfinancing? What are the prevailing interest rates? What are the changes in the interest rates? Whether they have reduced the housing loan interest rate, whether they have changed the temporary overdraft like excess interest rates. Yes, they have changed a lot. Right? So you need to be aware of all those things. Right? So you can't like always refer and see, because some of the data we have may be outdated right now. Now, what's the maximum housing loan interest rate these days? Any thoughts? Maximum? I know it's going at 8%, 9%. What is the maximum that you can charge through a circular? What is the maximum credit card interest rate these days? 32, 28, 24? What is the OD rate? Temporary excess maximum? Yes, Senesh saying 18%. What is the excess maximum? Any idea? 24 is the OD maximum, so which we have 28 and 32 earlier. Credit cards, here's 18. Do you know that? Right, it's good that you know, Senesh, in terms of housing loan, yes, it is not 18. Probably, I'm not sure that whether you have put it to the housing. It's 15, right? Now, going rate is very much less than that, but since the rates has come down, but there may be, because there are some circulars also come to that effect. But good that you know, you go and find those things. What are the current rates? So I can say these things, but better you also get to know this thing at a current level, because sometimes the examiner could test us on those things which we think we are not 7% 5 years. No, it's there. It's there. The 7% in the sense, it's like, you know, it's not the maximum rate. It's the rate that they have offered where the first 5 years, it's a 7% as per the last year budget. That's a, you know, whatever the rate, you know, prescribed by the budget. But I must say that, you know, a maximum rate they kept at 15, right? This one is working 7%. It's been there because it's been offered also, right? First 5 years 7%, and then it's a variable rate beyond that. Right? I mean, these things very important, because sometimes an examiner put us on test. Not difficult, but only thing is we may not be very much thorough on that. So what example? Let's say now you go to a web and you say microfinance maximum interest rates. When you put that, you can see what is the microfinancing maximum rate, tenors, and what are the sectors, or whatever the recent act, and everything is there in the Google sometimes. So good that you keep it and save it and refer. Or maybe housing loan circulars. Just Google it so you can have it. Because time to time those things are changing, but if you are right into the credit, probably you will be getting it. But if you are not into the credit department, you may be outdated, because since that those things are not rooted or reached to you. But good that you get an idea wherever possible, but not like those days. It's if you go to a maybe commercial bank or the private bank, web bank, government bank website, so everything is there. So latest updates that you can get it. So I just want you to invite, you know, go and check all those things. Probably could be useful, not for exams all the time, but for your general knowledge, right? Okay. This is basically the central bank provincial office, because what I wanted to include this is because recent past we haven't seen anything be tested, but previously there were a couple of questions to write a short note, central bank provincial office, like that. There were some questions has been set. So that's why I have put the central bank provincial office, their objectives and the functions kind of thing. So please read through and keep this in memory, because sometimes there may be a chance that he can repeat this question, because now not like those days, central bank now has moved to different regional offices. They have established some regional offices and they operate it in regions. So why they have moved to the regions? Because they promote regional economic activities. So what are the objectives? I have given 3 or 4. So sometimes the examiner would ask us what are the objectives of central bank provincial officers. And then similarly, he could ask what are the functions carried out by the provincial officers. That has been also tested maybe 2015 and 16. Recent past I haven't seen, but better, because now the central bank also been active in different way, because this is again in the syllabus. So anytime the examiner could test us on these areas. So you need to know what are the central bank provincial officers and kind of locations and their objectives and their functions, right? Finally, this is again SME toolkit. This actually has not been, sorry, SME centers. This actually was a concept, again, came up from the budget, maybe 2017, I suppose. But though it's not widely practiced right now, but there are many banks who operate these SME centers within their regional offices, within their branches, depending on their requirement. Means SME center is a place where entrepreneurs can come and get the views, advices, not only financial, especially non-financial. Financial support anyway we have been given. No? We have been giving it. So when customer comes, we try to provide loans, advances, project financing. We do, but non-financial services like maybe IT support, marketing support, technical support, which we have not been giving. But with the SME centers form, we were planning to, actually we are doing that facilities as well. So that's why the SME centers are important in that context. Right now, many banks are doing this because this is very important. One thing is to improve the level of performance, improve the standard of the entrepreneur business conduct. So this is all non-financial. How to prepare accounts, how to manage customer relationship, how to go to new markets, how to use IT for finding, how to improve your processes, so many things, right? So sometimes that we have kept some computers in these designated areas, and the customers can have an access like that, right? This actually has been facilitated through this one. I think if I have finally included this one, SME toolkit. If you have access, and just go through and check this SME toolkit, because this has been developed by IFC, right? SME toolkit. You just go to the SME toolkit IFC, so you have that data. So very useful information. It actually useful for our some of the exam stuffs also. It's in both English and Sinhala, and even in Tamil and trilingual languages, yes, right? And it gives so many information about to marketing, to finance, to how to find a business proposition, to write in a project report, to everything. Like just go to and type SME toolkits. This is available. So I think customers also are aware of this and they are using, but sometimes we might not be aware, and because it's good that if you go and get and have a look on this, probably it be useful, because when you go to that sometimes you can find so many information, current trends also with this, because this has been developed jointly by Dialogue and the IFC, which has been practiced up to recently. I think right now also, I haven't been to this site for about maybe recent past, but you can also go and experience, because this not only provide the financial related data and non-financial related data as well, right? So that's basically what I want to cover today. So today basically we discuss about sources of financing for development oriented propositions. It could be individuals, it could be companies, it could be the proprietorships and all that, who are into development banking, right? SMEs corporates, micro entrepreneurs, and all covered. Importance here is we know who are the players first, and then what are the sources, internal, external. We discuss detail. Then we discuss about some institutions, right? World institutions who can support to countries where we need the development support. Thirdly, we discuss about other supports like tools, refinancing, interest subsidy, right? Interest rebate, credit guarantees. Those are support elements, support tools. Finally, we discuss about government policy, institutional support, procedures, which is available to support this development oriented growth initiatives. So if you take the session 1, session 2, and session 3, session 1 is totally about introduction, 2 and 3 SME related areas, and session 4, which we are planning to undertake on 23rd, this Friday, which is microfinancing. It's a different area where it's about micro entrepreneurs and their requirements, definitions, myths, issues, and what are the models that we can discuss in the microfinancing perspective. So those are the areas that we are planning to do in the 23rd. So if we are able to complete that in the Friday, probably next Sunday we will be able to attempt some past paper questions, because since that I am planning to do that while we are doing the papers, the lessons also, because we may not know adequate time is available at the end of the session, because it's a very limited and very tight schedule this time. So if the exams is going to be extended, then we have enough time. But if everything is coming as planned, then we might not have adequate time to cover the past papers also. So what we are planning to do is, so next Sunday we try to do some selected questions on the from 1, 2, 3, and 4. So then we know at least by when we move to project financing from the session 6 onward, so at least we cover some area, so you know where the questions, where could be the possible questions can come, so that also you can do your homework and your preparations, right? So having said that, I think I am almost done my area. So any questions from you? Any questions? Samin is asking about housing loan. No, Samin, it's not a refinancing scheme. 7% housing is a government basically has introduced that you need to operate at the 7% for first 5 years. It's not a refinancing line. Refinancing line is basically something about some development sort of activities, which is basically mentioned as a concession of interest rates and some features about these sectors and kind of thing. But this housing is not the refinancing, because it has come down interest rates and government wanted to promote the housing needs in the country. So that's why it's been operated at that level. Any other questions? Okay. If not, then thank you very much for joining me today as usual. So you were very timely. So we started the class at 8 and then we are almost there by now 2 hours. So today we basically discuss about, sources of development financing. And as I outlined, Friday will be have additional class. So there we are trying to discuss about microfinancing. So based on the progress, so they will discuss the past paper questions on the next Sunday, so that we can cover up some first 4 lesson questions on the Sunday. So whoever is unable to join on Friday, you can refer the the YouTube and whatever the uploaded data. And finally, so we'll be discuss the past paper question on Sunday. So I invite everybody to come on the Sunday if you miss the Friday class, because Sunday is more important, because I'm trying to cover some of the sessions, areas that we cover during last 3, 4 and the next Friday. so through some past progression, right? So thank you very much again. Have a great week ahead, right? Take care. Okay.